My name is Randall Morrow with Resin Investments, and today we're going to talk about adding real estate to your overall portfolio, and specifically real estate syndications and real estate investment trusts, or REITs. So the first thing I want to cover is, why would you want to add real estate to your investment portfolio in the first place? What are the advantages? And really it boils down to 5 different advantages. The first being diversification. If you're looking for a way to get away from the volatility of the stock market, there really is no more perfect way than investing in real estate. It has a very, very low correlation to the gyrations of the stock market. And so it's a fantastic way to kind of puts a portion of your portfolio into this separate little bucket, if you will, that consistently stays the same or appreciates slowly and doesn't have the wild gyrations of the stock market. The second is a potential for steady income. We have a lot of clients that are looking for a consistent check on a quarterly or monthly basis. And real estate is fantastic for that. Most of the real estate investments that you would potentially invest in are rent type properties. So it's a apartment complex or maybe a commercial office building, and they are collecting rent on a monthly basis. So that income is passed on to you in the form of distributions, which are paid quarterly, sometimes monthly. And so if you're looking for a steady check, it's a great way to do that. They're very similar to dividends in the stock market. Third is that they're a fantastic hedge against inflation. Generally speaking, real estate mirrors inflation, or a lot of people even say that real estate creates inflation. Whichever way you look at it, the properties generally stay consistent with inflation. And in fact, rent will rise as inflation rises. So it's a very, very safe way to make sure that your investments are not losing value because of that. Fourth, the tax benefits are phenomenal. So if you're looking for a way to lower your tax bill, there really is no better way than real estate, period. There is a thing called depreciation, which gives you the ability to show a loss on your tax return while you're still receiving those payments on a monthly or quarterly basis. And you can offset other income with this depreciation loss. So fantastic for tax benefits. And lastly, it's a real thing that you're investing in. And so you can go kick the tires, so to speak. You can walk your property, you can walk your investment. And for some people, that provides peace of mind, knowing that there's a physical thing that they are investing in. So now that we know why, let's discuss a few options as to what. And there's 2 that I want to discuss today. The first being real estate syndications, and the second is real estate investment trust, or a REIT. Real estate syndications also are called real estate private equity. Some people call it real estate crowdfunding. They have a handful of different names, but they're basically the same thing. And basically what it is it's a company that is formed for the purpose of investing in a piece of property or a series of properties. When you invest in a real estate syndication, you are becoming a part owner. You become what's called a limited partner, and you are truly an owner in that firm. And your investment goes to investing in whatever piece of property that they've set up ahead of time or told you about ahead of time. And these deals generally last between 3 and 5 years. It can last up to 10. You generally know this ahead of time before you invest, so you can kind of pick an ideal time for you, but your money is tied up during that period of time. The company is taking your money and investing or purchasing a piece of property, so they can't obviously give that money back to you until they sell the property. The deals, generally the way they work is you buy an apartment complex, and part of the deal is to put some money into renovating and updating the complex. And it might be something as simple as just throwing in granite countertops and new tile and things to make the property more valuable. And as a result of that, you're able to charge more in rent and fill up the building if it was partially vacant to begin with. So the goal is obviously to increase the value of the property. And then at the end of that, once that is done, you either just enjoy the rent, the increased rent, I should say, from that, or you put it up for, and that's kind of the life cycle of what a real estate syndication looks like. So let's talk about the advantages of investing in one of these. So the biggest by far advantage is tax advantages. Ultimately, can report a loss on your tax return, and yet you're receiving checks from them from the rent. So it's a fantastic way for high wage earners to lower their tax liabilities. Second is it has an incredibly low correlation with the stock market. You can imagine an apartment building on the street generally does not lose value like the stock market can in a month's time or 3 months' time. So there's a lot more stability. The downside, of course, with that is it's not liquid. You can't get your money back right away. You have to go through the entire life of the deal. And so you definitely only would invest dollars that you can afford to put aside for whatever the time period is going to be. And lastly, another disadvantage is it's a higher investment minimum than what I'm going to talk about in a minute, the REIT. So most syndications have a $50,000 minimum, some much higher. So now let's talk about real estate investment trusts, or a REIT. These are very similar in their purpose, in that you invest in a company that is planning to invest in a property or property. REITs are listed on the public stock exchange. So they're very similar to a stock or an ETF where you can invest, just as easily. You open up your brokerage account, you find the stock ticker, and you invest. So the advantage is they're highly liquid. You can buy one today and you can sell it tomorrow. And that it's as simple as that. The other advantage related to this is there's a very low minimum. You could put $100 in. The disadvantage of REITs is they're not taxed the same as a real estate syndication. So unfortunately, they're taxed as ordinary income. You receive payments the same way, but they're classified as a dividend. And so there's no real tax benefit to investing in a REIT. And the other disadvantage is they have a much higher correlation with the stock market. So even though you're investing in an apartment building, if the stock market tanks, if it goes down, generally most investors, when they feel that heavy fear from watching the stock market drop, their reaction is to pull out of everything. And as a result, they sell everything. And REITs is one of those things they sell. So you can have a situation where your investment has dropped 20% in a month, and yet the property is still worth the exact same amount technically, but you've lost on paper. So something to keep in mind. So in summary, difference between real estate syndications and real estate investment trusts. Liquidity, the clear winner is REIT. Investment minimums, REIT again. Takes very little money. You can get your money back right away. In terms of diversification from the stock market, it's the opposite. Real estate syndicates are definitely superior. They really don't lose value, on a daily basis because they're privately held. And tax benefits, again, syndication, absolutely hands down, there's no question. In fact, as I mentioned earlier, REITs really have no tax benefit or very little tax benefit compared with a typical stock or bond producing dividends. One thing I didn't touch on is tax complexity. And the winner there is a REIT, because the money you receive from them is treated as a dividend. It's no different than receiving a form from your stock brokerage. When it's tax time, you get a 1099, and that form is very simple, showing the amount of money you received from them. A real estate syndication, on the other hand, because you're a partner in their business, you receive what's called a K-1, which is in a sense a partnership tax form. And if you've never seen a K-1, they can be a little intimidating. They're actually not but that first time you look at one, you're going to be a little set back. So if you do your own taxes, you know, again, that first time is going to be a little intimidating. If you have an accountant handle your taxes or a tax preparer, they're used to seeing K-1s. It's no big deal. You're going to pay, you know, a little more for their time to handle that K-1, but it's not a, you know, it's nothing that can't be done. I hope this helps, talking about the differences between syndications and REITs. And more importantly is just for you to consider alternative investments that can lower the volatility in your stock portfolio. That's all for now. Hope you guys have safe investing in the future. And please feel free to reach out to me if you have any questions on this. I'd love to help you guys. Take care. Bye-bye.